one, absolute truth about the stock market, what to do about it, and then finally, is it time to sell stocks? Is it time to sell and move into something more conservative? So first things first, the absolute truth about the stock market. Nobody knows if it's going to go up, down, or sideways, and when it's going to do it. There is nothing that you can do with 100% certainty to make the stock market go up or make it go down, or to predict that will go up or will go down. Speculation is difficult, particularly about the future. That is a fact. That is a fact. It's probability, not certainty. So you cannot control the direction of the market. Believe me, I've tried. I've tried to control the direction of the market. I've done research. I've talked to people. I've given my opinions. I've woke up in the middle of the night in a cold sweat and found additional research to back up my opinion that it's going to go up or go down. It doesn't work. That doesn't matter. It does not matter what your opinion is about the stock market. It does not matter which direction that you think it's going to go. You have absolutely no control about it. So what do you do about it? Do you worry about it? No, you don't worry about it. There's nothing to worry about because you can't control it, so it's not fair to worry about that. And then secondly, what you can control in the market, you can control, and so you don't need to worry about that. And so don't worry. What do you do? What can you control in the stock market to alleviate worry about the direction? The number one thing that you can do is control risk. That's the only thing that you can do. So how do you control risk? The most popular way that people control risk is that they buy a lot of different investments and they hold on to it and then hope over time that it goes up. That is diversification. That's the efficient market hypothesis. That is the random walk theory. That is that school of camp. It's the relative rate of return school. And that's okay. And that's fine. And that works fine in certain market environments. In a deflationary market, there are two types of markets. Inflationary, where prices are generally rising, and a deflationary market where prices are generally declining. In a deflationary market, diversification oftentimes does not hold up simply because asset classes tend to correlate together where they don't necessarily do that as much in an inflationary market. So that's the problem with just diversifying your assets and hoping that it goes up over time. The second way to control risk is through what are called absolute measures. And so you have triggers of when to buy and to sell. You have triggers of when to get into the market and when to get out of the market. You're measuring risk by a specific dollar amount or a specific percentage of the portfolio. And that's what we subscribe to. So we have really 5 ways that we can control risk. The first way is we want to define, are we in a risk on stance? Are we in a risk off stance? Do we want to be involved in the market, or do we want to be out of the market, or possibly even short? And so we do that by measuring 12-month momentum. We're measuring the S&P 500, the MSCI All World ex-USA Index against short-term treasuries. If over the past 12 months, the S&P 500 is above the treasuries, the 3-month treasuries, then we're a risk on stance. So we're looking for buy signals. We're looking for reasons to buy. We're not so much looking for reasons to sell. The second thing that we do is we decide, when are we going to be wrong about this particular investment? When are we going to call uncle? When are we going to get stopped out? When are we going to know we were wrong? So that is the second thing that we do. Thirdly, once we define that, we have a point in which we can get it down to a percentage of the portfolio to purchase. So that's the third thing that we do, is we position it in the portfolio so we're not taking an exorbitant amount of risk for each particular position. The fourth thing that we do is we have 2 purchase prices. We have the first purchase price where we get involved in the investment, and then we have the second purchase price where we're purchasing it either at a lower price or even possibly a higher price if it just shoots off and it starts to run. That's the fourth thing. The fifth and the final thing is we are disciplined. We are absolutely disciplined. You have to be disciplined. If you buy a particular investment for a reason and then you decide you're going to sell an investment for a particular reason, you have to hold to it. You absolutely need to. If you don't, you're jumping from plan to plan to plan. You never learn. You never get to improve your system because you never have a system long enough to learn from the mistakes. And so that's the fifth thing that we do is we are extremely, extremely disciplined in our behavior. And finally, is it time to sell stocks? Not quite yet. Not quite yet. 12-month momentum is still positive. Barely. It's about 3% away from being negative. And so we're pretty close. We're pretty close to the signal of a bear market, but right now it's still a risk-on stance. This past week, it came right down to support the S&P 500 did, and it bounced right off of it. So we got a buy signal. Coming into this week, we have a buy signal, and the trigger will be if we can get a price higher than last week's high. We'll see if we get it. But right now, we're still in a risk-on stance. We're still looking to buy things when they're an opportune time, and we're holding on to the investments we have, and we're holding our stops right where they are. So have a great week, and we'll talk to you next time.